So thank you everybody for joining us this evening. Welcome to the Multifamily Real Estate Virtual Meetup. My name is Chris Price. I am a member of the Boost Capital Group.
Partner,
Um,
partner.
Actually a partner, I should say, of Capital Group. And I'm joined here this evening with my partner, Philippe Shulligen. And our partner Jeff Rodriguez is not able to join this evening, but nevertheless, he is here with us in spirit. Welcome to the Real Estate Accredited virtual meetup. I'm looking forward to getting in the topic this evening. Just for those of you, for if it's your first time joining and you haven't joined us before, you should know that this meetup is actually every Thursday evening at 7 p.m. Eastern time, and we cover a range of topics from a multifamily investing perspective. I really believe that you guys will get a lot out of this. When you get into this space, it's really important to keep your education going as you continue to immerse yourself into this space and learn more about how real estate and can help you build what, especially passive real estate investing can help you build and diversify your portfolio. And as we like to say, boost your capital. So one of the things that I want to talk a little bit about just before we jump in, before Philippe presents this evening, please, from a logistical perspective, if you can, mute your lines, just so that can, keep down with any disturbances that may come up. We all know my kids are out of the house right now, so I have a little bit of peace and quiet for a few minutes. But if you do need to come off mute to ask a question, please feel free to do so if the question is urgent. We want to please note that this presentation is being recorded. Also note, just from a disclaimer standpoint, the material that we present this evening does not constitute an offer or solicitation to purchase any securities, and this is for information purposes only and should not be construed as business, financial, or legal advice. And I really appreciate everyone being here this evening. I'm looking forward to again getting into the topic. And without further ado, I'll toss it over to Philippe to introduce the topic for this evening.
Thank you, Chris. Thank you, everybody, for joining. Glad to have you. Sorry to have started a little late. We are tonight going to talk about series of presentations, Unlock Wealth in 2024. Tonight, we're going to talk about mastering the art of multifamily deal selection. And it's a topic that has come up with several investors and students in the past few days and weeks, and we think it's important to go over what we do and how we came to define a set of criteria. So we'll go and discuss like our 5 angles that we are pursuing to select a deal, and then how we do due diligence. And we'll conclude pretty much the presentation by showing like the effect that this process had on the performance of the deals that we've selected to be part of our fund. So we are recording, as Chris mentioned. Please, for the sake of keeping the recording that we're going to post on YouTube tight, we'll answer any questions you may have at the end. And then we can chat, by the way, a little bit and let people introduce themselves to each other. All right, so mastering the art of multifamily deal selection, as I mentioned, our 5 angles, then basically the two parts of our secret sauce, and we'll see the effect that it had on the performance of our deals in general. So number 1, our boost deal filter is we're going to look for experienced sponsors. And that's a very important piece for us. Obviously, like the people who are going to run the show, obviously, like the longer experience they may have, the better. The more units under management, the better. The more full cycle deals, etc. But we set the bar, and the bar is 5 years in business. That's number 1. Number 2, in a particular market, we're looking at least at 1,000 units or $100 million under management, minimum of 4 full cycle deals. Vertically integrated is preferred, and actually now it's almost like a requirement for us to consider a sponsor. Yeah, very important. Also have a team size that is in line with the size of the portfolio. I always use the example of the foreclosures that happened last year in Houston. They were like 3,000 units, I believe, but he was a gentleman. Basically, him, another young man was doing his investor relations, and 3VA were managing 8,000 units. It didn't end well. So it's very important to have a solid team that is able to take care of the portfolio. And finally, we're going obviously to take a look at the track record, but we're going to go over the specifics about that a little bit later on. On number 2 out of 5 criteria that we look at, and that's also a very important, and I can't about that the hard way, but we're looking for larger MSAs. We have 500,000, but in general, ideally, we want 1 million plus in the, say, the market statistical. What is it?
Metropolitan statistical area.
Yeah, thank you. Thank you, Chris. I forgot for a second there. We want to see growth in those markets. We also want to see diverse employers in diverse industries. We'll remember the closing of automobile factories in Detroit some years ago. We want to see employment growth that goes in tandem with population growth, but it could be a good indicator of the upcoming growth. When you read news and you hear about companies that are going to move in some places, though I would say we're always taking the employment growth, I'm sorry, the news about companies moving to particular markets with a grain of salt, because sometimes there are effects of announcements, and it may or may not materialize. I know there was particularly in Georgia, I would say 2 years ago, an electric car
President.
company
Yeah. Okay.
that was supposed to build a factory. And I believe to date, they still didn't break ground because they ended up having some legal concerns. They were sued by the county, or I forget exactly the details, but at the end of the day, that factory, they didn't break ground yet. So next, we're looking for quality assets. I would say these days we're particularly looking at 200 plus units. Why that number? Because when you reach that number of units, it's going to be institutional grade assets, large enough to be purchased by large funds like the BlackRock and other REITs out there who are interested in buying turnkey multifamily properties for cash flow, basically. So it adds an opportunity to an exit strategy, or a pool. The pool of buyers is larger when they have deep pockets. And they are very serious buyers too. If they start the process, they're going to close. Also, we're looking at class A and B, and that's something I learned the hard way. I put the definitions of class A, B, and C here on the right side. The class A means it's pretty recently constructed, usually less than 10 years old. Usually it's going to be in prime neighborhoods, high demand, high prices, and you're looking at white collar type of tenants. Also very demanding tenants typically, but relatively easy to manage nonetheless. Class B is going to be a little bit older, still in pretty decent neighborhoods usually, less new, and that's where usually there's a better opportunity to improve the value of these particular deals in a value add type of context, but still pretty strong tenant base and easy to manage. Class C, that's where I would say like the problems may begin. Sometimes heavy maintenance, tenants to get them to pay on time and so on. It's very labor intensive. I'm actually asset managing right now two properties that are definitely in that solid C and maybe a C plus, and it's very, you need to have on-site management pretty much, and people chasing you to get the rents paid. Usually less desirable neighborhoods, and at the end of the day, the risk when you go from A to B to C is higher. So that's why like right now we're staying away from class C. It's too many headaches. Next, we have what we call We're looking for business plans that allow for conservative appreciation. And from that standpoint, if in case you are not necessarily familiar, typically when you're buying real estate, there are four categories of assets or business plans rather that you're going to consider. And it ranges from core to core plus to value add to opportunistic. And in that order, the risk is going to be higher from core to opportunistic, but the returns also, right? It's typical factors that you will find in any investment. The higher the risk, the higher the returns. Usually we are not looking for core because it would be a newer vintage asset where the value add is not necessarily there. And so usually you're more looking from that standpoint at it's a cash flow type of purchase that you would do. And here we're showing like an example of return 7 to 9%. Sometimes, and interestingly enough, just a note on the core, which would correspond to a class A type of asset recently built. Noteworthy is Class A, the builders who are building Class A properties, they are very conscious about leaving meat on the bone for the next buyer. And they do that on purpose. They could reach technically much, much higher valuations and much higher performance of the assets that they are building. But purposefully, they're going to maybe not have the highest rents possible, and they will leave a lot of other income type of opportunities available for the next buyer to implement. We do have an example like that in one of our deals, actually, with a Class A, and it was quite amazing to see how many other sources of income that we could add in that particular deal. But so core plus is going to be between core and value add. Let me describe the value add first. Value add is really where there is a strong opportunity to add value by doing pretty medium to high renovations on the unit to achieve a higher rent. And really core plus is in between core and value add. So it's going to be a little bit more recent assets with little lighter renovations. Yeah, let me finish by giving the definition of opportunistic. So opportunistic, it would be either heavily distressed asset that will need full gut rehab type of renovations. You're going to really buy an asset in that case for pennies on the dollar. Otherwise, opportunistic also applies to ground up constructions. In those, in either case of heavily distressed or ground up, the risk is higher because there are usually a lot of unknown factors, and so many steps in a process to be able to complete the business plan, to succeed in the business plan, like too many variables. So that's why we like the core plus and the value add in the middle. That's the typical business plans that we like to see. And that's why we call that the conservative appreciation approach and filter for us. So finally, on that slide, also the time frame that we're looking for is typically like 3 to 5 years. And the idea there, usually the business plan to force the appreciation, it's going to be executed in around a year to 2 years. But then the 3 to 5 year is really to give a little bit of flexibility on the exit and set the expectations. Investors like to be ready to stay there for 5. And actually, right now, like the two assets I mentioned earlier, we're in those assets for over five years, well, 6 years actually.
So Philippe, just before you move on, there are a couple of points in the chat that I thought would be helpful for you to actually speak to for the recording, and it is specifically about, the question is from Paul, and it's about what year would you define the Class A structure, not the dirt, but the actual structure.
It's usually like the commonly agreed upon definition, it's 10 years. As long as you're within 10 years, you're in a class A. I think I agree with that, certainly.
Yeah, sure.
And then just from my perspective with what you have on the screen here, I would just simply say that each investor's risk tolerance, as you have communicate the risks that come with each strategy here, it may vary. Some investors may have the risk tolerance for the development deals that could have a huge equity pop at the end, or while others might not have that type of risk tolerance, if you will. And so I think it's important to note that each investor is different in terms of our philosophy and what we're focusing on, that those middle two are what help bring us the value that we're seeking.
And yeah, the risk tolerance, and also I think what's too particularly in an opportunistic is something I forgot to mention, but I believe it's important to mention. The idea of what we do the most, which is in place value add multifamily, is to enter an acquisition or buying a cash flowing asset. So you want to be able, like day one, you're going to start making money just by operating the asset. And the idea you were looking at, actually, let me change the slide. There you go. So the idea is that typically we're looking for 5 to 10% cash on a yearly basis. And that's what a in-place value add type of, or core plus or value add type of business plan would allow to return the 5 to 10%. I would say these days it's certainly on the lower end. Because of the interest rates, it's much harder to get to the 10%. 5, 6, 7 years ago when I started, it was not uncommon to have an average of 8 to 10%. These days, it's rather closer to 4 to 5. And just okay. And the difference between opportunistic, you may have to wait for a good amount of time, a year to two to maybe more, to see some cash flow. Chris said the returns are higher, but again, the risks are higher. Maybe I found a chart. Yeah, each time you go to the higher, see, is that this chart you wanted to see bigger? I know it's a little blurry.
Philippe, that one's fine. It was the last one you had with the coins on it.
Oh, you like it?
Yes, I like it.
I did it myself.
You did?
Yes,
like
yeah,
it.
it's a part of a video actually. It's a
Yeah.
screenshot from a explainer video.
And about the time period, I know it says time, but like the sale and refinance, would you say that's year 2 or 3? What would you?
No, that's just an illustration here. Just an illustration.
Okay.
Yeah. But the idea is, if you think about it, I think it's a good, you bring up a good question there. So we're looking at 2x equity multiple, right? So 2x equity multiple, which means you're going to achieve 100% in 5 years. But let's say now you're doing very good deal, good performance, you're going 10% cash on cash every year. So it means after 5 years from a cash on cash to cash flow standpoint, you have made 50%. And at the sale, because you did the value add, you forced the appreciation by doing renovations, for instance, and you increase the net operating income, therefore the value of the asset. Now you can sell the asset at a higher price than what you bought. And meaning that the sale, or in that case, a scenario that I described, you're going to generate 50% of your returns at sale and only like 10% during the hold period. So that's why I'm showing the distributions much lower proportionally to the sale, right? So you're going to take 10% every year and then 50% at the end. So it's proportionally is much bigger. Though it's just an illustration, it's not perfect from that standpoint. My little chart there, my little illustration. And also, yeah, the IRR, it's always, I describe it as the internal rate of return. It's how hard your money is working for you. I think it's the easiest way to understand, because otherwise the formula is pretty complex. And so if you're comparing two deals, you see a little bit of a better IRR. It means that your money will have worked a little harder for you. Though each time, if you're looking at a 2x equity multiple, so you'll probably be in the 14 to 16 range. That's pretty typical these days. All right, so next. So that was the fifth actually layer or fifth angle of our different filters, right? So we had the sponsor market, the asset type, the business plan, and finally the target returns. Those are the five. So next, once we find a deal and sponsor that meet those criteria, we go to the next step. The next step is, and that's our part of our secret formula, part one. We have I'll make it bigger. Don't worry, problem. Yes. We have a more than 200 points proprietary due diligence checklist that we're using. And we can see particularly at the bottom, so we have team that we're going to look at, the details about the investment, the property, the business plan, the market, debt, legal, underwriting, and physical. Again, it's part of our secret sauce, so I'm sharing only with either my students or investors, and we are under a non-disclosure agreement in each case, so we don't want to reveal the secret sauce to everyone. I cannot hear you, Paula, if you're trying to say something. Okay. You look happy. Next, so just to give an overview a little bit more in details about this due diligence checklist, what we're looking at a little more specifically. So the first part is we do a sponsor due diligence. So we're going to look at who is running the company, their history, company structure, the track record, the number of active investments, exit performance. Also a little more in detail, the active portfolio, see what's going on for anything that is under management, performance, anything pertaining to capital calls or debt risk where there could be some interest rate cap that would be expiring or something of that, some things of that nature. And finally, also very important, we are doing a background check, and it's not, I know that, I guess I learned about that because we actually ourselves went through that process. All the partners of our fund, we went through pretty exhaustive background check that was run by the company that we're using as a fund or fund portal, but also it's much more than that. They're helping us like organize this pretty unique product that we have, which is a customizable fund. And for them, it was very important to run a background check on every fund manager that they bring to their platform. They checked on who they bring on. And so they're using a product that is called Clear from Reuters. And even in that, there's a light background check and there's more thorough ones. That's what we're doing for any sponsor. And we'll see. We don't see like that social, that kind of stuff, but we see anything that they've been arrested, that they had a ticket or something as light as a ticket would show up. But obviously, we're looking for much more serious issues there, such as bankruptcy, any lawsuits, or SEC related sanction, etc. So from a deal standpoint, again, like a little bit more color on what you're looking. So we're going to look at the offering as well as the private placement memorandum information. So we'll review in depth what the opportunity is about. Obviously, the business plan, the structure, financial, the risks, etc. Part of the due diligence. Then the pro forma. So basically, we're redoing an underwriting just to make sure that whatever is presented makes sense. So we can review the underlying assumptions. Yeah, sources and use is more like structure actually, but the cash flow, the income projections, etc. Just make sure that everything that is displayed is it's easy to make a model too good to be true or better than what it should be. And at the same time, it's easy to do a mistake. I'm working with students regularly, and sometimes in underwriting, it's easy to do a mistake and have the content of a cell that's not, you overwrite a formula or something like that. Then we talk about the market. And here I just put a partial list because we're looking really market, sub-market, as I mentioned, growth, crime. We're looking at median income in a market, the median income that is 3 times your rent target. And obviously, you're looking at comparables for rent and prior sales. We're reviewing the purchase and sale agreement just to make sure there's no, sometimes there are pretty complex terms and that could be detrimental really like to the whole transaction. But yeah, we take a look at the purchase and sale agreement, at the loan docs, and also the operating agreement that is going to explain the legal structure and ownership, etc. So that's an overview of the content of the checklist. So our secret formula part 2. And on this one, we go beyond, I think, the checklist. And there's a number in this list I'm displaying here. There's a number of things that really we must have. Some nice or nicer to have, but some are really must have. And just let me go through the list. Obviously, we want to buy below market price, but it's nice to have. It's not always something we can have. Though I would say recently we've been fortunate enough to work with sponsors who have access to these deals that are below market price. So that's the odds of making good returns increase, obviously. Also, very important, you want to buy properties that are their current rent that are below market. And the idea is that there is a gap that is wide enough between the current rents and your target rents to leave your target rents in line with the market. That's the idea. That's a very important factor. So we always look for that. That's a must. That's a must. Loan to value also has been more of a concern, I would say, these days, based on the higher interest rates. And I would say in general, it's better to have lower loan to value ratios. And so I think these days we're looking at maybe 70%, if I remember well, maximum, or something like that, maybe 75. The norm used to be at 80 to 85%. So 80 to 85% of the purchase price was financed. But now we're more looking at 70 to 75%. Also, it's something we discussed at length during one of our past sessions, the pref equity. It's very important to understand that preferred equity in a deal, they're going to have priority compared to the other investors. And sometimes if there's a little amount, it's not 10 to 20%, it's not critical. But if you have more than 50% of the equity is preferred equity, it's very important to understand that these people will be paid first before everybody else. And if anything is going wrong, they're going to be paid first before everybody else. So now you're in a much, much riskier position if you are behind pref equity. So that's also something that's very important for us. We don't want to put our investors in a bad position. Ideally, we're looking for a low year one growth of the net operating income compared to the net operating income in place for the past 12 months. You want something that is in line with that. So basically you're saying year one, if I'm performing in line with what the current owner has done, and then only later I can see my business plan, the effects of my business plan. If your underwriting works in that context, it's a pretty conservative underwriting. And so that's pretty also something we're looking very closely for. Ample reserves, that's something that's also very important, especially you just never know. It's very important to have enough to be able to face any type of headwinds. So that's where you're going to have reserves. And reserves can help you, for instance, if you have a variable interest rate, which is typically, I would say traditionally not recommended, but in case you have one because from a financing standpoint made sense, or it's on purpose, some operators are using that strategy of variable interest rates, you must have an interest rate cap. So to put a ceiling on the top of the variable interest rate. And so that's where the reserves, they could help renew the rate cap down the road if in case you're in an adverse situation in the market and it's not a good time to sell. And so that's why that's one part of how reserves can be used. The other one is when you perform stress tests, meaning that you're going to have you're going to change, for instance, so what if you're going to do what if scenarios, meaning, for instance, let's say you plan for 90% occupancy. What if you're at 85, right? What if you're at 80? What if you're better? So how does it affect the returns? Are you breaking even or not? And so now, just an example, but you're going to apply the stress test on what if the cap rate is a little better? What if it's worse? What are the effects on the returns? But the most important is to see where you would need reserves to cover any headwinds again, right? When you do the stress test on the different parameters. Finally, you want multiple exit strategies. And that's very important. If you remember, I mentioned earlier the 200 plus units. You want to be able to have as many ways that you can sell the asset as possible, because that's when you realize the value add and you want to get out. And again, if you can sell to deep pockets funds and it's a 200 unit, it's better, it's easier, and there's demand for that. So that's why ideally we're looking for these types of assets, of pretty large assets. So the next slide here is something I've shown maybe a month ago, but continue to work a little bit more and define the different criteria. But our five angles or pillars to filter the deal: the sponsor, market, asset, business plan, target returns. We've graded them from 1 to 5, 1 being the weakest, 5 being the best. And here I set like some notes regarding the different criteria to hit the higher number. Just a note on target returns. The 3, which I would say it's middle of the range in that case. That's the meaning. So you're looking for a 2x return on the investment in 5 years. So anything that is in line with the 2x in 5 years would have a 3. And then if it's a little bit lower or longer time frame, like you do 2x in 6 years, it would get a 2 in that case. But as you can see, industry standard 1.9 or 2 in 5 or 6 years. Everybody's looking for the same type of returns. It's very in the value add world. You're looking at doubles pretty much. But my point here, so looking in retrospect at all the deals since I started to do real estate, plus the deals we have in the fund, and doing this 1 to 5 on the 5 different filters, I come with different grades. And we see we have a total, just added the numbers, 16, 17. So the maximum we can get is 23. And pretty much in all our deals except one where we're at 22, but in all the deals that we have in our fund right now, we have set the bar pretty high. And so far we are in line with the performance. So which is good news. That's we want to have consistency. That's our goal. And you can see like more historically where we didn't have that same level of filter, the results have been less consistent. And sometimes they're a little bit below what was expected, so sometimes much better. But at the same time, this deal, we sold it when it was the peak of the market. Again, you're looking for 3s, that's stability, but of 2, 5, 2, 4, 2, couple of 1s. But ideally, you want something that's more repeatable recipes. Yeah, that's just wanted to give an overview how we filter deals. What do we do after we filter the deal to all the due diligence steps? And for more assessment, how high we raise the bar and to achieve this quality and consistency. And that's pretty much all I have. Chris, you have a comment before we open the floor there?
Philippe, I think it's always great to share. My immediate comment was, how much of the secret sauce are you going to share? What I was thinking as you kept going. But no, in all seriousness, I think it's really important for folks to understand how thorough the due diligence how thorough it is, and how important that is for us as it relates to protecting our investors. And I think it's just I think it's something really important. At a minimum, you should be as you engage with other operators, other fund managers, you should be challenging them to make sure that they can illuminate for you how they're assessing the assets that they're putting in front of you. But Philippe, there were a number of questions here that I'm actually I want to catch up on and read them out for you so that we can address them. And so I'll start with one of the top questions here. This is a question about the deals and the types of deals that we have. So are the deals for only accredited investors, or are sophisticated non-accredited investors invited to our opportunities as well?
So the deals in our fund, it's a 506c fund. Actually, I spoke earlier today with the founder of the company we use, and we were discussing that particular thing about 506c, 506b, so meaning accredited only or a mix of non-accredited and accredited in a fund. There are a number of constraints that come with doing non-accredited, so that's why we went with accredited only. However, I think as a company, we're going to offer opportunities to the investors with whom we have a pre-established relationship and who are not accredited. We'll extend some opportunities to them. Or the filters we've described, they're going to be a little bit different. It's a very good question, actually, because we're probably more looking at emerging operators. That's what we want to help as well. And in that case, we will have a managing role in that particular deal. So that's the type of opportunity that we're going to offer to non-accredited. We'll have a little more flexibility on some of these criteria because we'll be in a management position. So that's no, it was probably longer answer than what you expected, but
no, it's good context. And there was a comment about potentially converting from a 506, starting as a 506B and then converting to a 506C. And in fact, I do in previous deals, I have had some experience in that as a part of the general partnership team, and start where an asset, an investment opportunity that we brought started as a 506B for a period of time, where we could offer that investment opportunity to those folks who met the criteria. And then after that, we would work with the SEC attorney to convert the deal to a 506C. This is something that has definitely has become a little bit more common, but that's in a deal specific syndication. That is not applicable in the case of our fund of funds, which we have, which is a specific 506C fund, as Philippe mentioned. Another question. Oh, go ahead.
Yeah, no, go. I was just saying, if any, feel free to unmute yourself and we can have a conversation.
Yeah, sure.
You don't have to. No pressure.
No, in case people are shy, I'll hold my water. If they're shy, I'll read out the questions.
Hey, Philippe, the reason I found out about the hybrid was from Mauricio Raul, because he's the SEC litigation attorney that he does his presentations on Monday at 1:30 Central. And he taught us about people that ran out of money. They couldn't raise anything. Now, of course, a fund is set, right? But if you have a syndication on a property specific and they ran out of money in 506B, then they converted to C, and then they were able to finish it and raise the money. That's where we learned it from. Relatively new.
I guess that's a way looking at the empty cup. I feel, but yeah. It's a real possibility that exists now. I know it was first time I heard about it was two or 3 years ago. The conference Dugan Kelly was talking about. What I heard someone say about Mauricio is that his marketing strategy is to basically, I forgot the word, but like to project fear to everybody. So that's how he's getting his clients, basically. Like a scare tactic. There you go. So he's scaring everybody, and that's how he's. I think he's the only one who is so extreme on some of this stuff.
he's never tried to do that with us, so.
I don't think
well, because
so.
you don't know what you don't know. I'll have a conversation with Mauricio, and then you have a conversation with others on some
I
of
just-
the gray areas. That's
I think it's more realistic. He just picture the picture. He just picture the picture. He paints the picture in a real world. This and this could happen. Not all of it might happen, but it could happen. So I don't think he's based out of fear. I
Well,
don't think so.
You
I
remember
really
he
don't
was
think
a
so.
litigation attorney, guys, so he was in court for malfeasance of SEC regs. So to me, of course, that's going to be somewhat his history.
yeah.
Anyways,
It's interesting when you compare, because this is not obviously the only one. You compare like everybody. There's an outlier. That's my point. And in my opinion, is an outlier from everybody else is saying pretty much the same and is much more like
Contrarian.
Yeah, it's interesting.
Well, we
You
shall
know, it's
see.
like even he was talking about customizable funds at some point, and it was a very kind of narrow way to look at things. And some of this stuff he was saying were not even true. It's like we had a conversation within our group. Like out of maybe 5 points, we had one was valid, and the rest two were okay, no problem, and the rest was not really pertinent. So that's my 2 cents.
Especially in this market, we all have to run the course, right? If you look at comparative investments, real estate to me is more stable than some of the other things that are happening in the market. And it's illiquid. So that's a great thing because of it being illiquid, then it's hard to pull all the money out of it. Something tragic would happen. So to me, and also your 5-year plan, if the market didn't react well to your sale, it's hard to sell. All you can do is postpone it a couple of years when the cycle changes, and then it's a great investment again. To me, for all those reasons, plus the tax benefits, it's a great deal. And I have to say, Philippe, you do a superb job on due diligence. You're very thorough. Most people don't know that about you. I can tell you're very thorough.
Thank you.
For that, I congratulate you.
agree.
Yeah.
Thank you.
That's the
Kudos.
engineer. It's the engineer in him. Sorry,
I
Adriana.
love it. I should have been an engineer. I want to be an engineer.
Love it.
It's not too late.
Love Philippe.
Not too late.
Uh,
It's awesome.
but yeah, well,
Well, I think there was one more question that
one more
Adriana
question.
had.
Okay.
Please. Did you have a question?
No, I'm good.
No,
Okay.
good. Okay.
Thank you.
Denise,
Denise, any questions?
any questions?
Got to come off mute. No, I don't have any questions. Very thorough presentation there, Philippe. Thank you very much.
Thank you. I appreciate it. Thank you. Okay, so I guess we're going to conclude and just put our contact information of Chris. If you scan the QR code, you can see his bio. Same thing for my partner, Jeff, who's on the road today. And my information as well. You have our email addresses. And if you have not subscribed yet, please subscribe to our YouTube channel. The address is youtube.com/@boostmycapital. And on that note, thank you again for joining us. We will see you next week for another session, another real estate accredited meetup. And have a good evening and a good holiday weekend. Enjoy the unofficial beginning of summer.
Memorial weekend. Yay.
Yeah.
Enjoy. Have a
Thank you,
great
everyone.
one.
Thank you. We'll try.
Bye-bye.
Stay safe.
Have a beautiful
Bye-bye.
weekend. God bless you all. Bye-bye.
You too.
God
Bye.
bless you all.